welcome to another episode of Beyond the Waypoint. I'm Benton Blake with Rise Wealth Management and Planning. I've got Skyler Martin with Maxim Wealth.
Yeah, it's great to be here. I think this conversation today is one that I have fairly often with clients. I'm sure you do too, and I think that it'll be a good one.
Yeah, absolutely. Yeah, let's set it off, especially with all the volatility that's going on in the markets right now.
Yeah, it's been quite the year, but the thing is, like, every year is quite the year when you're an investor, when you're following the markets. I mean, I can't remember the statistic, but in every positive year in the S&P, a 15% drawdown is average and expected. So anyways, that's kind of what we're talking about today is investor behavior, right? So many investors spend their energy trying to pick the right fund, analyzing ETFs, figuring out which manager is right for them. And that is an important question to ask, but it's not the most important, and it's the one that gets the most time, unfortunately. What's interesting though, is that there's a lot of research out there now, and it's pretty consistent. The gap between what a fund earns and what the average investor actually gets is sizable. And that difference isn't from fees or anything else. It's from investor behavior. And so today I think it'd be fun to walk through some of the most common behavioral mistakes that investors make, why they happen, what they look like in the real world, and then what you can do as an investor to help mitigate some of those potential mistakes down the road.
Yeah, I think it's important we start with the numbers, the research on this, right? So what does the research actually say about investor behavior?
Yeah, there's a lot of studies out there. I'm going to talk about a couple. The first one is one that Morningstar does. It's called Mind the Gap. And what they found is that investors consistently underperform the actual funds that they're invested in, which is wild. So for instance, let's say you own an S&P 500 index fund, okay? And let's say, over the course of 5 years, it does 100% in return over that time period. Well, the average investor might see, 80% over that same time period. And it's not because of the fees. It's because they're buying and selling at the wrong times. They're moving in and out of the fund. And historically, though, that gap is about 1% to 2% annually. So they're actually underperforming the funds that they're invested in by about 1% to 2% annually, which blows my mind because that is a significant amount when you compound that over a 60-year investment time frame, right?
Yeah.
So that one is really fascinating. The other one is from Dalbar. They do a quantitative analysis of investor behavior, and they track this every year. The average equity investor significantly underperforms the S&P 500 over time. And now, I don't have a huge problem with underperforming the S&P 500. For instance, in 2000 to 2010, the S&P 500 is pretty much flat. Like I don't want to make that like the benchmark for investment success, right? Yeah. But it's just a benchmark, and the point with that is that someone who's invested in stocks, right, which are largely going to be reflected in the S&P 500, actually underperforms the S&P, and it's not because of the funds. It's because of the timing and behavior. They're moving in and out, like I said. They're making a bunch of trades, and over a 25-year accumulation window, missing out on 1% to 2% a year is hundreds of thousands of dollars, right?
Yeah, for sure.
So, I mean, you're meeting with clients every day. How do you discuss this with clients, and do they get it?
Yes, I think eventually they get it. They usually get it, and they're coming to us because of their own errors, trying it themselves and being like, wow, this is hard. And again, it's not the funds. It's not picking the funds that's hard. It's staying invested. And I've always thought these studies were interesting because all you would have to do is sell out of the S&P on a day or a week where it goes down 1% and then buy it back. And then you've outperformed the S&P by 1% in theory, right? Because you saved yourself a 1% decline. But yet, when people try to time, and how I discuss this with clients is it's not just about getting out, it's when are you going to get back in. People usually don't, even if you time that out, you get out and then you see the S&P going down, you don't go right back in thinking, well, at least I outperformed 1% or 2%. Right. No, you're like, this is just the beginning. I got to stay out on the sidelines. And when you look at the statistics of timing getting out being off, and then you pair that with the statistics of then having to time it back in, you'd have better luck at the blackjack table by far.
Yeah. Yep. Absolutely. So let's talk about some of these, most common mistakes and what they actually look like in real life. So the first one is panic selling, and I think that the way that academics call this is loss aversion theory, right? Kahneman and Tversky kind of coined this back in the day, and it's become a very common thing in behavioral finance and economics. And the idea with loss aversion is that losses feel about twice as painful as an equivalent gain feels good. So when markets drop 20%, it hurts about twice as much as it feels good when markets are up 20%. Is kind of the idea, which is wild, right? So for instance, in COVID, the S&P dropped 34% in 33 days. It was wild. And we had no idea what was going on. It was, there's headlines everywhere, and a lot of investors sold. But they locked in losses, and the market fully recovered in about 5 months, which, I'll be honest, probably isn't a normal recovery time. There's a lot of stuff that went into that. However, it illustrates the point. I think one that's a little bit more tangible was in 2008, 2009, because there's another statistic that again, it blows my mind when we read this stuff. For equity funds, so S&P 500 index funds and other funds like that, the outflows, money going out of those funds peaked after the worst part of the drawdown. So in other words, people sold around the bottom of the market and then were out of the market as it started to recover.
Yeah, it reminds me of that cartoon of the guy mining for gold and then turning around right before he hits it.
Yeah, exactly. Like it's interesting, but like the point when everyone is yelling at you to sell and telling, you're hearing from all your cousins and brother-in-laws and everyone at the barbecue that they're getting out of the market, that's usually when it's about to turn back around.
Yeah.
It's not a fact, it's not like a hard set rule, but that tends to be how it goes. So that's the first one, loss aversion. People, tend to sell at the wrong times. The other one is chasing performance. And this comes across, the academic term for that would be recency bias. In other words, we assume that what just happened will keep happening. So, you have a fund that ripped 150% last year, a bunch of money piles into it afterwards, and then it does 8% the next year. That's kind of how it goes. There is one specific tech fund, I'm not going to name it here, but it was up 150% in 2020. And like literally 150%. And a bunch of money came into it early in 2021. And then it dropped 75% from its peak. And so you had a bunch of people who got in at the top because this thing was ripping, and then they watched it drop 75%.
Did this fund start with an A?
It did, yes. It did. And so that's like, this thing where we're just chasing performance. We think that whatever worked last year is going to work this year, and that's just not always the case. I've actually been hearing it with clients where they'll say stuff like, well, the S&P just does 15%, and so like, why would I take out, why would I put money down on a home when I could just, stuff like that, or like when the loan's 6%, like the S&P does 15%, why not just take the loan? And I'm like, wow, where have we come from? Like it's, and it has averaged that for the last 15 years. But it's that recency bias. And that concerns me when people start talking like that.
Yeah.
Right?
There's a reason the average is 10%, not 15. Yep.
Yes,
yeah.
Exactly. So of course you have the 1990s, right? You get the tech bubble, money's pouring in at the top. The NASDAQ drops about 80% from 2000 to 2002. And it took over a decade to break even after that. The other thing that really interests me is that if you missed just the 10 best days over 20 years, so 20-year time frame, you miss the 10 best trading days during that period, your returns get cut in half. And what's even more interesting is that those 10 best days usually happen within 2 weeks of the worst days. So in other words, when it feels terrible being in the market, when there's headlines all over the place and you just watch it drop 4% in a day back to back to back, that's often when there's the biggest bounces, and that's when it's the best time to be invested. So anyways, it's
literally saw that last week. Yeah.
Seriously, it was wild. We had that last week. So that's another one. The third one is just overconfidence. So it kind of speaks for itself. The most active traders, the people who think they can beat the market, who think they know more than the market, and that kind of mantra, they historically and on average significantly underperform the least active traders. So I'm talking about like, look, you might have a couple of years where you beat the market, you're outpacing all your buddies, but on a 30-year investment time frame, which is what I care about as a financial planner, you are typically going to underperform those who just stick with their investment strategy for a long period of time and let it do its thing.
Yeah,
that's just the numbers. Think about like 2020 to 2021. We both saw the meme stocks going crazy. And almost all of those ended up getting the rug ripped out of them as the people who were kind of leading the charge decided to take in their gains, and they made a bunch of money, and then everybody else on the Reddit thread lost all of theirs. Right?
Yeah, that was a bummer.
Yeah. Last one is anchoring, and this is really common. Like I remember last week or 2 weeks ago, someone had said, "Hey, the market's down. I want to try to get my money in now." And he'd had some money come due and he wanted to put it in. I was like, great, yeah, we can do that. But I just remember thinking in my head, I was like, the market's not down. Like, in what respect? Like, you started investing in 2001. The market's down 7% from its highs in 2025. I'm curious, like, what do we mean by down here?
Yeah, yeah.
Like it's down 7% this year. And so, anyways, what happens is you pin this high watermark, and then you make decisions based on that instead of the current reality. So, some examples of this in real life would be like you buy a stock and it doesn't do well, and you decide you're only going to sell it when you gets back to what you paid for it, which could be never. And you hang on to this company that is a loser, so to speak, right? Or employees who own stock in their company, right? They don't want to sell because it's down from its high. They've pinned this high watermark as the price, and they're never going to sell until it gets back up there. Here's the thing, though, that people need to remember. It's a very pithy one-liner. The stock doesn't know what you paid for it. It doesn't. Okay.
Wow.
So we just went through a few of these: loss aversion, overconfidence, anchoring, and then recency bias. Which of these do you see the most often with clients, Ben?
Yeah, I would say it's a combination between anchoring and overconfidence in the employee stock purchase plans and
Mm-hmm.
employee comp. Like the stock comp plans, just the reason why I bring in overconfidence is they are working for this company where they feel like it is a winner. It is different
Yep.
from the rest. They have insider information. They know the trajectory. They know it well, and we're always taught invest in what you know. But they also see that it just has gone up, and and they anchor to that momentum, and that will keep going up. And they're going, well, why would I diversify when I'm getting 30% each year with my company
Yep.
stock? And we have seen it recently with some employees who at a company where the ones working with us, we were able to convince them into diversifying, a good
Mm.
portion of it, not all of it, but then others, they literally fired their advisor because their advisor was telling them to diversify,
Oh, that hurts.
and it is down over the last year. Like the 2-year look back is negative right now,
Yep.
and
Yep.
it's awful. So yeah, I would say that those are the biggest things we run into. So if behavior is the problem, I mean, what I'm curious as an advisor is what's the fix?
Yeah, and that's our job, right? Is to help mitigate the risk that, for lack of a better phrase, that clients pose to themselves, right? So that's what we're trying to do: is help investors protect themselves from their own behavior. We're never going to eliminate emotion altogether. It's natural, right? But what we want to do is try to get emotion away from the decision-making point or process. And so there's a few ways we can do that. First is just going to be to write it down. Get an investment policy statement for your plan written down that answers some of those key questions in advance. Because, like we tell clients, it's not an if question, it's a when, right? So when the market falls 30%, what do we do, right? And sometimes the answer is nothing. We continue to rebalance semi-annually. We make small quarterly tweaks, and we stick with our plan because we have these goals, and this portfolio is designed to get you there, right? So we write it down, and then when that happens, we can revisit that investment policy statement and say, Mr. and Mrs. Client, I remember when we came in and we sat down and decided that this investment policy statement was going to be our North Star for your portfolio. Do you remember that? And we can have that conversation. That's the first one. The second thing is to automate contributions. I mean, it's so simple, but just systematic investing is the best way to, in my mind, build wealth over a long period of time. You don't have to decide when and where to invest. It just happens in the background, and you're investing and building wealth by default. That's the easiest way. The other one, and this would be the third kind of piece to this, is to get a second opinion before you act. There's nothing that breaks my heart more. I should take that back. There are things that break my heart more, but facetiously, this is one of the toughest things: is when a client comes to me and says, "I just sold everything in my 401k and I moved to cash." And this would be for someone, maybe I don't manage their 401k. This is at their work, and they just moved out of the investment portfolio that we built for them within that, and they sold everything and moved to cash. We had some that did that in April of last year, sold at the bottom, locked in 15% losses, and then missed out on the gains that followed. And my point with that is to get a second opinion before you make a big decision like that. Don't just sell because you read a few headlines and it's too much to bear. Talk to your advisor. And if you don't have an advisor, this is where it really helps to have one. There's a phone call that should happen before you liquidate your entire investment portfolio.
Sure. Yeah.
I mean, it's like we talk about with spending habits, right? Like if you're going to go and think about making a $5,000 purchase, depending on your income and net worth, I would recommend waiting on that a couple weeks to think about it. Like, it shouldn't be something where you see the deal at Costco and you're like, I'm getting it. That's how we end up in trouble. Let's think about these things. Let's talk to someone. And then the last thing is it's kind of around education. And with clients, I usually start with education when it comes to this. But we got to learn to reframe volatility in general, especially for people in their 20s and 30s and 40s and even early 50s. When you're accumulating assets, when you're in the accumulation phase, as we would call it, a market decline works in your favor. It's not fun to see, but you're buying these companies at lower prices. It's the same companies. Nothing has changed. They just have a lower price. And so it's helpful to reframe it in that way. So that's kind of how I think about it. But for you, I mean, what else would you add? What are you doing with your clients?
Yeah. How I bring that up
Yeah.
proactively, again, changes on the phase. If they're in accumulation, the thought process I like to plant is, hey, if the market's up, look at your portfolio value. But if the
Mm,
market's down, look how many shares you're buying for the same dollar amount going in, right? Because they
nice.
usually have some sort of a systematic contribution. It's like, don't focus on the value, focus on how many shares you're getting, for the same dollars. It's
I
more
like
than
that.
what it was before. For our clients in distribution, right? We've already carved out 2 to 3 years of income in an
Mhm.
income bucket for them to live off of. So it's like, remember, we planned for this, we got you. So it's more about, we definitely don't want to touch this. Let this recover because we have this over here.
Yep.
But yeah, that's no, I think that's a great way, because half of our job is psychology, right? And I
Yeah.
love that you mentioned our biggest value can be from convincing someone not to sell at the wrong
Yep.
time.
Yep. Yeah. I mean, for if someone has $1 million investment account and they wanted to sell last year after locking in 15% losses, and you kept them from doing that, and the market ends up being up 15%, which it was last year. I'm assuming they're probably not all in stocks, but let's say they were for sake of argument. That's $150,000 value right there.
Yeah, yeah, and that right there is not. It's ultimately the client's money. So while
Yep.
we'll do what we can to coach them and help them, if you're listening
Hmm.
to this, don't think that we're telling our clients what to do. We're just the CFOs, but we
Yep.
will heavily advise them not to do it. But ultimately, it is their money, their choice.
Yep, yep, 100%. So I mean, if you're a DIYer, great. Just keep in mind, like figuring out what to own, what stocks to buy, what ETFs, whatever you're using, that is important. I don't want to misrepresent that. It is definitely important. But the bigger question is how you're behaving as an investor when things get uncomfortable. You can have a beautiful portfolio and still underperform it by a large amount just because of our behavior. So my point with all of this is to learn these things before it gets tough, so that when it does get tough, you've already thought through, hey, I'm feeling this right now. Here's why. Let me go back to X, Y, and Z that we had talked about before. So anything else you'd add there, Benton?
No, I love it with everything going on. And again, this episode is being recorded April 20th, 2026. So everything with the Iran war and the Strait of Hormuz and the volatility we've experienced, this is a great episode for
Mm-hmm.
what we're currently facing. So,
Yeah.
dude, I appreciate you diving in, Skyler. Skyler right now is studying for the CFP right now. So, there's a lot of good information he's learning from that. So I'm excited for him to continue to share, what he's learning on that journey.
Yeah, me
Um,
too.
yeah, like and subscribe to watch more videos on how we help our clients see beyond that next waypoint.